Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're having a returning guest, Marvin Loh. He is the Global Market Strategist within the Multi-Asset Research Team at State Street Global Markets. He is also a Managing Director there. His primary responsibility is to leverage State Street proprietary institutional behavior, risk, and inflation metrics to monitor the market developments and formulate their impact on global currency and interest rates markets. He got his BS and MBA degrees from Stern. So thank you for being here again, Marvin.
Great to be here. Thank you.
So one of the things that has come up a lot in the last week or so is the sustainability of the U.S. federal debt. You know, I've been expecting this to come into focus for, I don't know, about 20 years. So what are you all seeing in that?
Yeah, for sure. And you're right. It's one of these stories that seems to come out every decade or so. Certainly there are a lot of concerns now for sure, given that we've got a big increase in the budget expected next year. We're already at record levels. More recently, we saw the refunding announcement where the Treasury increased their issuance. This week is a big start to that, but it's going to continue to increase as we go into next year. So, the amount of debt continues to increase and, we continue to watch it. It hasn't been a problem up until now, so you take a step back and you think, okay, what's different this time? Well, for sure, the amount of debt itself is getting to levels which historically have caused countries to particularly externally funded countries to have a problem. We would normally have those problems if it wasn't for the fact that the U.S. was the reserve currency. Kind of having said that, we've got changes in potential foreign buyers. So certainly what's going on in Japan kind of fits into the discussion at this point. And really kind of pretty much the uncertainty around how inflation is going to evolve and whether or not we've got divergences coming in these economies that makes it either more attractive or less attractive to invest in cross-border markets from a sovereign perspective is all that's coming into the mix right now.
Okay, so let's unpack that a little bit, but first some nomenclature. So you all look at this on a debt to GDP basis, I presume?
Generally I look at it at a debt to GDP level. That's probably easiest. Kind of having said that, the absolute amounts are relative when you're trying to get a sense of how much liquidity might need to come out of the market in order to fund it. So,
right.
The beauty about U.S. data is that there's so much of it. So we can really cut and slice this in a number of different ways just to get a sense, overall sustainability is debt to GDP, but just really the impact on liquidity. We'll look at absolute numbers as well.
Mm-hmm. Now, one of the things that I know you all have been working on a little bit is the what's largely called the supply overhang.
Yeah.
So could you talk a little bit about that? Because I think that's exceptionally interesting.
Yeah, for sure. So, there is a massive increase in debt that's coming. Like I mentioned, this week alone, we're adding 38 billion in new 10 years that we're going to issue. We've got a 30-year auction. So there's just a lot of duration that's coming in the market.
Right.
That supply is going to continue to really make its way into the market over the next couple of quarters. At this point, the U.S. government expects the deficit in their next fiscal year to be about $1 trillion.
Right.
When we add that to the large amount of issuance that occurred earlier this year, once we resolved the debt ceiling, you're really talking about trillions of dollars that are coming into the market, all of one credit, and that supply overhang will push other securities and the demand for other securities theoretically to the sidelines. So we look at it from that perspective, trying to really understand the impact that's going to have on liquidity overall.
Okay, and also I just would like to just underscore one thing. That deficit forecast you talked about is a forecast.
It is. It's the numbers that we're using the CBO's numbers. It's a great starting point. One of the things that was interesting to me in the recent downgrade was that Fitch had actually numbers that were higher than the CBO.
Yes,
and a lot higher.
Yeah.
And when I kind of look at what the CBO's estimates have done since, let's say, last summer, where they came out with 23, 24 estimates, they updated them in February. They updated them in June again.
Right.
And each one of those instances, it just increased fairly significantly. And ultimately, inflation is a story that the federal government needs to deal with, but also the interest rates that they assumed are much higher than they thought a year ago. much higher than they thought in terms of potentially a steady state in February. So all of that's coming together where these estimates continue to increase. So Fitch might be the right baseline to begin with.
Now, that's a very interesting place to take this maybe next, is about longer or higher term yields. There's going to be an impact on federal funding. There's going to be an impact on the types of investments. What are you all seeing in there?
Yeah, I mean, there might be, right? This has obviously been the concern that, like I said, and you referenced, comes up every decade or so, where we kind of have this big jump. Is all of a sudden deficit funding going to increase rates significantly going forward? The potential that Japanese investors are less active, foreign investors potentially could be less active in the U.S. going forward is a touch point that I'm spending a bit of time on. I guess I would encapsulate all of that in the concept of term premium. Is there a supply and demand imbalance that's going to require more premium in the treasury market in order to clear? And at this point, it's unclear whether or not inflation goes back to kind of the steady state 2% or under 2% that we had before the pandemic, whether or not we get kind of that marginal cross-border buyer coming into the market to help stabilize some of the increases in issuance the way we had before the pandemic is a question out there. If a lot of these things come together where it becomes more of a challenge and you've got a lot more debt coming into the market, you're going to have higher term premiums. I'm not saying that all of a sudden we're going to have failed auctions. It's not as if I believe that there will not be a buyer for treasuries. It's just really a matter of what that level is. And what's been interesting is that as we kind of go through this recession discussion, as we go through kind of this sticky inflation discussion, as we go through kind of the structural changes in not only the US economy, but the global economy, a lot of these risk assets are expecting the new world, the post-pandemic world, to look a lot like the pre-pandemic world.
Right.
One where you get kind of lower growth, fairly robust balance sheets, and stable inflation. If any of those become a problem or don't evolve the way the market expects, there's going to be higher term premium, there's going to be higher equity risk premium that's needed to kind of clear the cost of these transactions, if you will.
Okay, and let's just get under the hood of that for a second because it's fascinating. How do you and your team study all those things?
Yeah, so some of the proprietary data that we have around our State Street indicators kind of helps us get a sense. So I and anybody that wants to come and chat with us can look at real money flows and holdings. So what I've done recently is kind of look at these holdings, not only in total, in terms of how much real money is buying in treasuries, but how much of that foreign buying is making up that total number. And I've noticed, still need to do a little bit of work. Correlation and causation are always one of those risks that we wind up getting into.
Right.
But it does look like that real money foreign buyer has been a marginal price setter for the treasury market.
Okay.
And if we see less appeal to that investor group, I would think that term premiums, a lot of different ways to measure term premiums also, but we'll just use the one that Bloomberg provides, easily the Fed's version, the ACM version of term premium. One would expect that the negative term premium that represents right now could go higher, could potentially go into positive territory, and then you wind up with a steady state long-term yield that could be 50, 100, 150 basis points higher than what the market is implying now. That's a big jump, but certainly it's within the realm of consideration at least.
Okay. Are there other sort of tipping points? I'm using air quotes for those of you who are listening to the podcast. Are there other tipping points out there that you all are looking at vis-a-vis this debt load? Yeah,
I mean, for sure, it really does come to demand and then the politics around how big the deficit gets. Again, I could criticize Fitch for sure. There's no reason to think that the U.S. debt cannot be paid. We issue debt in our local currency, and the U.S. is the reserve currency. That is incredibly powerful. Having said that, Fitch did raise a lot of political issues, a lot of willingness to pay type of issues, debt ceiling, and really kind of the environment in Washington. It does seem as if there's not a lot of fiscal stability and sustainability in their discussions. So that winds up being a potential tipping point too as we go into the election. Wants to promise something to the constituents during the election. So we're entering this period where Treasury is going to issue a lot more. There certainly might be a shifting of foreign buyer demand. And then if all of a sudden the politicians promise even more as we go into next year, you wind up with a lot of debt. Is that a tipping point where we get, again, a failed auction? No, but does term premium, which spiked recently with a lot of these discussions. It settled back down. Again, the power of the Treasury security, if you will, in global finance. But it did highlight that, you know what, we should be considering what term premiums are once we get through the pandemic.
Yeah, and I just want to unpack that for a second. So in a lot of sovereign ratings, capability to pay is the sticking issue.
Yes.
But willingness to pay is becoming more a bigger risk in some respects.
For sure. Particularly in politics, particularly in the populism that has evolved around politics. Within the developed world, it shouldn't be an issue. These countries issue debt in their local currency, which they could print.
Right.
And that should be enough. But the willingness to pay, that's certainly something that's become more of an issue over the course of the last, 5 or 10 years or so.
Yeah. Well, now I'd like to move down a thing, but we are very lucky as we were recording this here on August 9th. Yesterday, the banks moved into focus a little bit more.
Once again.
After charge-offs were a little surprising, particularly credit card charge-offs and what might be coming in the commercial real estate market. So what did you see in yesterday's number?
Yeah, so the rating agencies are generally behind the curve. What Moody's said about banks, whether it was the watches that they put on their actual downgrades, is not new news. News that we actually talked about the last time I was here. It brought those concerns back to the headlines,
right.
Certainly. And it, for the most part, affirms the view of those of us who are concerned about the banking system. Again, not necessarily from the perspective of, okay, we're going to have a lot of failures or defaults. It's certainly not that type of discussion to me. But it does show that it's a difficult operating environment. It's either challenging to find deposits.
Right.
Banks are still at this point struggling against money market funds, struggling against other short-term instruments. Their portfolios themselves, a lot of it was created or was ultimately purchased on their end a few years ago when rates were significantly lower.
Mm-hmm.
And then you've got different default profiles now as we go into the later stages of this cycle. A recession would certainly make these portfolios look a lot worse, but even kind of the natural cadence of getting back to longer term averages means that there's more defaults kind of coming into these portfolios. And in addition to what we heard from the banks, we heard from the Fed in terms of some of their consumer surveys that we've got more credit card debt than we've ever seen. We topped $1 trillion. So you've got a lot of debt. Defaults are still low, but they're increasing. And you got banks that are more strained and less capable of dealing with this. So to me, it's still kind of that strange brew that makes one concerned about the amount of loan creation that banks are going to be able to do, are going to be looking to do, and ultimately whether or not there's an economic concern that evolves out of that. And I think that there is. The loan creation is an important part of the economic cycle here in the U.S.
Yeah, I mean, one of the things that's difficult when you're coming out of any sort of strange period like we are, is you have to ask yourself whether charge-offs are going to continue to increase or if this is a normalization trend.
You know what? Either or at this point, it's problematic for banks. If there's a good discussion out there as to whether or not rates are restrictive enough. Mm-hmm. We can walk around Times Square as we are here. It doesn't seem like it's all that restrictive outside.
I'll say.
But the one area that you could say it certainly is restrictive is in the banking system.
Yeah.
So if you've got these charge-offs increasing into balance sheets that are already restrictive, only a couple of things can happen. Either you wind up with problems servicing your depositors, or you need to shrink your balance sheets.
Right.
Either or does create a challenge for ultimately credit creation, which is what I'm looking at in terms of, okay, as we go into next year, the more robust consumer that's kind of kept this economy afloat, is he going to be able to if credit winds up being much tighter than what it is now?
Right. Are there other parts of the economy that you're looking at in tighter credit creation situations?
I mean, certainly commercial real estate, right? That's front and center. We've got the big WeWorks discussion that's out there now, whether or not they're going to be an ongoing concern.
Right.
Nothing proprietary there that was announced today, but I think it shows just how the office market is evolving. And the biggest lenders to that commercial real estate are the regional banks,
right,
which happen to be the ones that seem to be the most stressed. Happen to be the banks that are most challenged in obtaining deposits. And when we look at the amount of money that the banks have borrowed from the Fed, from the home loan banks, those numbers they've really stabilized. It's not as if the problems have gone away, even though the headlines have gone away. They still need this extra capital. So again, you get a little bit later cycle. The balance sheets are already strained. I think it's safe to say that from a tightening perspective, rates are restrictive for them already. How do they respond? Do they shrink their balance sheets? Do they cut back on their loans? Do they have more charge-offs? Probably all three of the above in the next couple of quarters.
Okay. And just in terms of the size of the impact of these two things we've talked about, credit card metrics don't usually change that quickly. But I wonder if a lot of these things are going to be difficult for some of the commercial real estate investors who've started with this mantra of stay alive until 25.
Yeah. Certainly. What is the term? Extend and forget?
Extend and pretend.
Extend and pretend. Yeah. Thank you for that. I think it's going to be harder to extend and pretend for sure. A lot of these commercial real estate transactions are structured so that they renew every year. So it's not as if they have a long, refunding cliff that they can ultimately, hope that the economy changes by then. That's front and center. It's going to be a pretty significant concern for a lot of the slices of the bank that have exposure to that.
Right.
Is that enough to really create an economic problem? In and of itself, probably not.
Right.
But if you can't lend into that part of your portfolio, there's a good chance that you wind up creating this negative feedback loop where other parts of your lending activity ultimately also get pulled back. And remember, we're still looking at a Fed funds rate that's 5.25%, 5.5%. We'll see the loans that they're making from their portfolios when the Fed funds rate is in this 5+% range is 7 to 10%,
right.
maybe more.
Right.
Who wants to borrow at those levels also? Who can afford to borrow at those levels? So you put all this together and, it certainly is a restrictive environment for some.
Yeah, it's exceptionally interesting. It's something you also said there, I just want to underscore a little bit, is it seems like you're focused on this as a risk to some of the regional banks, but less so the GSIBs?
Less so the GSIBs. I'm not necessarily, so in my seat, I don't do a lot of analysis on the sector and or company level. I'm looking at it more from a global macro point of view. And certainly the lending that the regional banks make into Main Street is an important part of the credit creation process.
Mm-hmm. Mm-hmm.
And if we're concerned about that, we are concerned about small businesses, which, ultimately create most of the jobs in this country.
Right. Over time, for sure. Yeah. All right, great. Well, this is a lot to think about, but thank you again for being here, Marvin. We'll have you back in another quarter.
Excellent. Thank you for having me.
And thank you all for listening to this podcast. If you'd like to learn more about our upcoming events, please visit our website at cfany.org. Until next time, I'm Rob Rowan.